We're following tech stocks. Another rough day here for the NASDAQ after that big downturn we saw at the end of last week. Tesla was one of the names hit hard in the sell-off, turning in its worst week since March 2020. But the company is making inroads, we learned today, in China, just setting a record for monthly deliveries for September. Joining us now is Bernstein's Tony Sacconaghi. Tony, your market performance, I know you're not particularly excited about Tesla. Is it the fundamentals, or do you think it's the broader market backdrop?
Sarah, we've been a little bit more cautious on Tesla for a couple reasons. One is we still think its valuation is very high, particularly relative to other automotive stocks. And secondly, we do worry fundamentally that it may be difficult for Tesla to continue to sustain this 50% growth rate that it's promised going forward. And I think, quite frankly, despite the good data from China today, China is probably the one area of the world that we, and I think more broadly, investors are increasingly worried about.
I should correct myself. Your underperform rating on Tesla, $150 price target. So why do you think China's a worry if we got those good delivery numbers today?
What happened, Sarah, over the last several months is the best leading indicator of Tesla's demand in a given region is how long you have to wait to get a car. And in China, that was 14 to 22 weeks, 3 to 6 months ago. It's now 1 to 4 weeks. And so Tesla had a very large backlog in China. It has a very limited backlog in China right now. And we've seen that happen also in the U.S. We think there are more plausible explanations for why that's happening in the U.S. But in China, it does feel as though we are potentially starting to see some incremental softness in demand. And that's, for a growth stock like Tesla, it's all about growth and top line growth. And so I do think this is an issue that we all need to pay attention to going forward.
Yeah, you think it's going down to 150. You think Apple is a market perform in 170, which is interesting because Apple has held up relatively well against the market. Even when it gets hit pretty hard, it's still, it hasn't been making new lows. Why?
Apple has really been viewed as sort of this stable consumer franchise. They did very well during the pandemic. They've done quite well this year. And so folks view Apple as this great consumer franchise and brand that is relatively steady. I think, the big question is, like many other companies, is Apple impervious to potentially weakening consumer spend going forward and shifting spend? So one is consumers will be increasingly, their purse strings will be tightened because of higher rates. But the second is this potential concern that we're seeing in the PC world where, folks were spending a lot on electronics during the pandemic. Now that the world's opened up, they've shifted those dollar spend away from electronics and home furnishings to other things like experiences, travel, entertainment, et cetera. And so that's really the $1 trillion question for Apple, particularly over the next, 8 weeks or so when we get more data points on the true strength of the iPhone cycle, is can Apple continue to plow through despite the fact that it did very well during COVID and despite the fact that we have an incrementally weakening consumer?
Yeah, and the latest IDC data was actually quite positive for Apple, showing that, global PC shipments fell across the board, Lenovo, HP, Dell. Apple was the exception, and they actually rose 44%. You cover a lot of these companies, Tony. So I saw you put out a new note on IBM today. You're also pretty cautious there. Are there any companies within your sector that you cover that you like right now and that you would say represent a really good buying opportunity?
Address just the Apple and the IDC question, Sarah, because IDC collects data largely submitted by PC OEMs. Apple does not participate in submitting or sharing its data with services like IDC or Gartner. And so historically, IDC and Gartner's track record for predicting Apple on a quarterly basis has not been great. So certainly the numbers look very good. I would just be a little cautious about extrapolating that. To your question about broader tech, look, we think tech is fairly to slightly overvalued, so we're not particularly bullish on tech. We are a little bit worried that we may have earnings estimates go down. There may be a little more downside to the market. And as a result, we prefer really inexpensive, more defensive technology names. So companies that I follow, like Dell and Hewlett-Packard Enterprise, that are trading at literally 5 to 7 times earnings, we think have relatively less downside in the near to medium term. And so that defensive posturing leads us to those names.
Got it. Tony, thank you. It's good to check in with you. Tony Sacconaghi. Appreciate it, from Bernstein.